Ewan, are you one of those people who's worried that this high interest rates are spoiling the party?
I mean, the high interest rates certainly have had an impact on the banks. We're talking a 12% interest rate movement in the last quarter of last year. And obviously this will have a negative impact on the bank. But so far we've seen them do a number of measures to try and protect the quality of their lending. And so far it seems to be paying off.
What is the likely long-term impact of this? Because after the latest central bank monetary policy committee's bringing down of the CBR by 150 basis points, interest rates are coming down, but this is still very marginal. What is the long-term impact of this?
I think it's important to understand what the banks did before or as the interest rates increased. They could clearly see that their lending quality was going to be put under severe pressure, and we saw across the board a lot of the banks increasing the term of their loans so that the consumer wouldn't have to pay more interest on a month-to-month basis. So what this in effect did was protect the asset quality of the banks up front. Obviously long-term is not sustainable. There's an asset liability mismatch that's going to become a problem over time, and the consumer's paying more over a longer period of time. So it is important that we see these interest rates coming down. You know, the consumer can probably support it for a couple more months, but you know, going into the end of the year and into 2013, we would hope to see significant cuts going forward.
You know, I had a conversation with Madowo, Managing Director of KCB, the largest bank by asset base here, and he doesn't think interest rates will be coming down, at least not to levels around 15% in the next few months, maybe not even the next half year.
Yes, I mean, I think I'd subscribe to that view. The 150 basis points we saw at the beginning of July was later than people were calling perhaps a year ago, and going forward, unless there's a sustained and continued decline in inflation rates and Kenya's shillings, the strength, we wouldn't expect to, well, perhaps a few more cuts, but nothing significant. The next question then, of course, is whether those interest rate cuts can be passed on to the consumer. We saw when in the upward cycle, a lot of the interest rate increases were absorbed by the bank because they realized, both from a practical perspective and from a political pressure perspective, that if they passed all those increases on, the consumer wouldn't be able to cope. So when it comes down again, perhaps there will be a lag, and banks will try and claw back some of those losses.
And then we have the election coming up, the general election. The last time we had a general election, it was a very chaotic affair. So what does this portend for the banks in this country? You know,
I think with the interest rates and the elections, a lot of the banks have adopted a wait-and-see attitude. When we looked at first quarter bank results presented by the central bank, it showed a slowing of credit growth, a significant slowing. So that, I think, really speaks to the wait-and-see attitude of the banks. The elections, you know, I mean, we all hope they'll be peaceful. Certainly the banks have an eye on the election. I think post-election, if there's a successful election and a peaceful election, that's when we'll see a significant return to growth in the banks. Before then, I think it'll be slow and it'll be cautious.
Kenya has just under 50 banks. Do you feel there's potential for consolidation in this space?
It's a very interesting question. My observation is the consolidation perhaps isn't a stated policy objective of the central bank, but they certainly are making moves that would suggest they'd like to see consolidation in Kenya. We know there's new minimum capital requirements that are being introduced this year. That certainly is going to force some of the smaller banks to relook at their existence. And you know, the big question for Kenya is, if they've got so many banks but no banks of scale, how are they going to compete with the big West African banks and South African banks? They need to consolidate in order to do those big ticket deals. But despite the number of banks in the country, you still see a very big foreign interest in Kenya. As you know, FirstRand opened its rep office a couple of months back, and there's talk of other banks also. So certainly, whilst there are a lot of banks, outside banks see potential, which is very good for everyone.
Because those South African and West African banks are coming into this space, like latest FirstRand, but the Kenyan banks are also beginning to venture out of the country. KCB, Equity Bank, and a few others are now in the region in Uganda, Tanzania, South Sudan. Do you feel these are starting to pay off? You know,
Kenyan banks in many ways have been pioneers in the markets they've moved into. I mean, as you say, South Sudan, they're Kenyan banks in Uganda, Rwanda, Burundi, Tanzania. There was even a chief executive of a major Kenyan bank talking about Somalia. So, you know, it's certainly they have to be cautious moving into those markets, but they offer very exciting prospects. what I would hope to see is, with the expansion of Kenyan banks, also see a great integration between the regulator in Kenya and the major other banking districts, so the development of the Kenyan banks and vice versa can be on a sound footing with good regulation and good oversight.
Ewan, many thanks. We appreciate your time. Ewan Gray, Emerging Market Financial Institutions Analyst at RMB.